Last week's economic calendar was dominated by the release of US inflation data. Although the overall year-on-year CPI number of 5.4% beat the expectations, the devil was in the detail, with a month-on-month increase of only 0.3%, the lowest monthly increase in a long time. This is the ActivTrades weekly outlook, where every Monday we analyze the economic calendar and identify key events, focusing on how they may impact the markets. Stay with us over the next few minutes while I look into how the week is likely to unfold. I will cover a range of topics, including the release of US retail sales, Eurozone GDP, and we'll end our analysis by previewing the UK's inflation numbers that will come out on Wednesday. Last week's release of US consumer prices data appeared to indicate that inflation in the United States has peaked. This interpretation of the data arises from the month-on-month CPI growth of only 0.3%, the lowest rise in over a year. Then, on Thursday, the Producer Price Index appeared to contradict the theory that inflation had hit the ceiling by showing an increase of 6.2%, well above the expected 5.6%. Finally, on Friday, the Michigan Consumer Sentiment Index dropped abruptly, causing a significant fall for the dollar index. In this context, with the dollar on a roller coaster as investors interpret data and try to anticipate whether or not the Fed will bring forward the timing of the tapering, the publication of American retail sales numbers for July will help to clarify the likelihood of earlier tightening and provide more direction for the dollar in the run-up to the Jackson Hole meeting later this month. On Wednesday, the Eurostat will release the Eurozone's GDP, a measure of the total value of goods and services produced in the region. Economic recovery in Europe has been advancing alongside a vaccination program that, after a slow start, managed to catch up and even overtake, in the case of some member states, that of the US and UK, for example. The consensus for the preliminary July numbers points at a growth of 13.7% comparatively to the same period last year. An expansion of such magnitude would, in normal circumstances, be a huge number. However, we can't forget that last year Europe was in the middle of a massive recession, which creates some perspective to the analysis of the figures. A positive number, which will be on consensus or just above, is likely to offer limited support to the euro, as the ECB, who recently shifted its stance towards more dovish policies, is unlikely to alter the scope of asset purchases or interest rates anytime soon. On the other hand, any disappointment is likely to generate more downside for a single currency that lost more than 3.5% to the US dollar since the beginning of May. We'll end our weekly preview by zooming in on the publication of the UK's inflation data. The previous annual snapshot, taken in June, measured at 2.5%, above the Bank of England's 2% target. The consensus for July points at a slight decrease to 2.2%, meaning consumer prices may have peaked in June. UK fundamentals have been supportive of the pound, as illustrated by the better-than-expected GDP numbers released last Thursday. So, a relatively high consumer inflation reading could offer more support to sterling, increasing the pressure on the Bank of England to taper its asset purchase program and even to start thinking about raising interest rates. So far this year, the pound has been gaining ground to other currencies, like the dollar and the euro in particular. However, most of these gains are linked to growing risk appetite in the financial markets, rather than the performance of the British economy. Nevertheless, a high inflation reading would still be likely to offer further support to sterling. This is all for today. We will be back next Monday for another weekly preview. In the meantime, please go to ActivTrades.com for more analysis. Do subscribe to our channel so we can keep you updated with the latest in the markets. And don't forget to click the like button if you enjoyed the video. Thank you for watching.